The European stock markets are open for trade, and the early course of trade over the week so far before this Friday session has been weaker. These markets giving back territory. We're down about 1 3/4% on the benchmark for the trading week. As we get going, we're picking up on more red from the US markets. Wall Street in reverse as many investors again weighed up the cost, real yields rising at this point, and what that means for a lot of these asset classes. So this morning we start weaker. We're down 0.4% just in the initial stages, giving back more territory. Some of the weaker trades this week, the FTSE has been one down the most. French market fairly similar. More resilient of the core markets has been the German stock market. I'll get there eventually. The DAX has been down about 1%. So in the context of the other core markets, slightly more resilient but still trading weaker. How this all compares to the US markets, we're down more than 2% in the ranges too for the big board stateside so far before the session today. Let's dive into this market. We've already had a bit of data this morning on retail sales out of the UK. They have been somewhat disappointing the market at this point. We've got basic resources at the bottom. Again, the negative news flow rolls on out of China, this time around the Chapter 15 bankruptcy filing from Evergrande. That's the big story for the mainland market today, but resources down 1%, real underperformer. Autos too, maybe picking up on that weakness for the Chinese consumer. Again, 9/10 down for that area of the market. Every stock in the autos basket starts weaker. Retail down 0.8%. Dufry, Zalando, H&M, M&S, some of the weaker ones down 1 to 2%. So some fairly decent sized declines starting to transpire. Banking stocks down 0.7. It has been a very weak trade stateside, down about 5.8% for the big US lenders. Household goods down 0.7, along with travel and leisure. Industrials 0.6 weaker. Financials sliding. Insurance names down by about 1/3%. Food and drink. We've got AB Foods, Diageo. These stocks all travelling weaker. Real estate names down about 0.25%. Oil and gas shedding 0.2, so that is a weaker trade today. Technology not too bad given the whole cost to capital equation. Again, as we look at real yields, 0.2 down at this stage. Telco's trying to stretch higher, and now Vodafone at the top of the basket, a jump of about 0.5%. Utilities in the green at this early starting point as well. Let's get into what we're seeing on the boards. The FTSE yesterday fell 5 negative sessions in a row, 0.6 weaker, another 0.5% coming off the market, and you can see we are below 7,300 points. 7,271 the territory, down 0.5% plus on French stocks, 0.6, a little bit more coming off the German stock market at this point, and perhaps again that catch-up trade that I was alluding to as we began the market open here. The IBEX in Spain, it is modestly weaker along with the SMI, roughly the 0.2 range versus a little bit more just falling off that FTSE MIB in Italy. Let's get into the China story. Evergrande Group has filed for Chapter 15 bankruptcy protection in New York in a move which protects the company from legal actions by its creditors as it seeks to restructure. Evergrande defaulted in 2021, shining a light on the country's wider property debt crisis. I think shocking many of us who'd covered this stock. It had $330 billion in liabilities as of July, according to Reuters. Shares have been suspended now for almost 18 months, and across the resources sector, declines of 1 to 2%, 2% off Antofagasta, 1.4% off Anglo American. To the big luxury names, there is a view every time we see some of these property stories rolling out of China that is going to compress the domestic spender. The luxury names here in Europe have very much benefited from the wealth of the Chinese and the largesse that they've been willing to spend on luxury. The big falls we're seeing, Swatch down 1.25%, along with Hugo Boss, Richemont 1.3%, Hermes in the red by 1.2%. Auto names, I mentioned how weak the overall basket was, 1.2% down for Renault and Stellantis, two of the giants in reverse today. Japanese core inflation hit 3.1% in July, down from 3.3% the month prior. The so-called core inflation, the Bank of Japan's preferred inflation indicator, which X's out fresh food and energy prices, rose 4.3%. That was up on the month, although analysts see that as a sign of services and demand-led inflation increasing, something the BOJ has been looking for. In terms of rates, dollar yen 145.32 morning session. Dollar is weakening versus the Japanese yen. Now, UK retail sales, as we dive into that sterling trade and what the big retailers are doing here this morning, it's just Ocado in the green. Everything else is showing some fatigue. UK retail sales falling more than expected in July as wet weather hit footfall. Sales volumes were 1.2% lower than in June and 3.2% lower on year, both well short of expectations, Steve.
Uncertain